Hello guys, welcome back to our value investing channel. Today we are going to discuss about Berkshire Hathaway, the company of our mentor, if we can say like this, Warren Buffett, discussing what is written in his last letter, the last quarter of 2020. So we are going to speak about four main points that we can take from that letter. The first one is the importance of the time in investing. We will see by a number how much is important time. Then we are going to speak about strategy. Then we are going to speak about how the business of Berkshire Hathaway is structured and what is the added value of one part of this business. And then the fourth point is to understand how much important is the buyback in a company. But finally, I will give as well the price action and my intrinsic value of the company, so which kind of strategy we can use to invest in this company. All those value investing analyses are made or by myself or in cooperation with the international value investor team I'm working with. So I leave above the link with all the playlist and all analysis we have done till now. But let's digging into the letter and start with the first point, that is the importance of time in investing. In fact, Buffett started its letter with all the annual return of Berkshire Hathaway and S&P 500 till 1965 to 2020. So we can say that Berkshire made 20% annual return compared to S&P 500 that is 10% annual return. So a really great overperformance. But the most important things to highlight of this kind of numbers is that from 1964 to 2020 the total rate is 2,800,000%. So 20% a year goes to 2,800,000% in total rate since 1964 to 2020. On the other hand, 10% a year goes to 23,000% in total return. So you can see how much important it is to keep your investment for a long time and how big your total return could be. Even if you just fit the return of S&P 500, it is almost difficult to fit, but even with an ETF, you can take the same return of S&P 500, you will end with this kind of total return that is just impressive, and it can really make a difference, make a bad investment or good investment, just keeping money invested for a very long time. So we can say the time was 1A, this one is 1B, is the fact that Buffett can say as all investor that he sometimes take wrong decision. In fact, they had to write down 11 billion because of some wrong evaluation of acquisition made in 2016. They acquired Precision Cat Parts. Buffett said that he was too optimistic about this company, so he just make a mistake. He still believed that the CEO of the company is a really good one and the business overall of the company is a really good one, and over time earning will be good from this company. But at the moment they just made some wrong expected return, so they paid too much for this business and they had to write down those 11 billion. This teaches us that even the best one can make mistake, so if sometimes we make mistake in our portfolio, is not the end of our investment. We are not judged by all investment that we do, but we are judged by the overall portfolio. And speaking about a portfolio portfolio, I want just to remind that you will find down below in the description the link to our public portfolio that you can see and eventually even copy. But let's go to the second important aspect explained by Buffett in this letter. It's a strategic aspect. In fact, he wants to highlight the difference between a conglomerate and its own business. In fact, he says that a conglomerate wants to own the business that they acquire entirely, while Buffett with his company, they don't want to take all the business or they don't want to control the business, but they are happy to have a part of this business. What's the main difference on those two strategies? The main difference is that not all good businesses they want to be purchased. So a conglomerate cannot buy, for example, Amazon, Facebook, or some other good business you want, even a small one. I said that to name just for an example, but just to say that maybe there are some good one that you cannot just buy. While if you just invest in them with a part that could be 5-10% or even something more, but just a part that you can normally buy with stock, you can invest in all kind of business. You can choose all the perfect business you want to invest in and fits your portfolio. This is something important to understand when we analyze a company, let's say a holding or something like that, because it makes a huge difference in what are the prospective return of the company. Third, and maybe most important things, is a focus on Berkshire businesses. In fact, they say that they have 4 main business in Berkshire portfolio, because it's even the largest one is the insurance business, which for 53 years has been the core of Berkshire portfolio. And we are going back to speak deeper in this business, but let's see what are the other 3. The other 3 maybe you already know, but the second one is BNSF, that is the largest railroad in US. The third is BHE, that is one of the main energy company in US as well. And the fourth one is Apple, for sure, that Berkshire owns 5% of Apple. And even with Apple, we are going to have a focus in our fourth point that speak about buyback. But to close this third point, we are going to discuss which is the main competitive advantage of those business run by Berkshire. We are going back to discuss about insurance, because this is the business that has the most important advantage. In fact, normally insurance made money by taking money from the client and investing in something that for law or for safety reason should be, let's say, bond, for example, or something that is really small risk. This is important because they need money, they need float money to always be available to maybe repay the client and so on. So in this moment in time, when bond has a really low rate of return and in some country has a negative return, insurance have many problems to be profitable. In the other hand, Buffett with its insurance company, they have actually 138 billion on the float, so they are almost, let's say, cash. They have to be cash because of the insurance business, but they can use this cash not just with bond, but even in some other way, maybe even stock or some other investment, even short term, but they can have some higher rate return than just bond. It could be enough, just 1% or 2% more than bond, to make a huge difference if you apply 1 or 2% to 138 billion. This makes a huge competitive advantage for insurance inside an holding as a Berkshire Hathaway instead that a standalone business. And this is something that is really important to understand when we are going to evaluate a company like Berkshire or some other holding company. The fourth point highlights the importance of buyback by company. In this case, the example is Apple. I said that we are going to speak back about Apple. Here we are. And Apple has been bought by Berkshire from 2016 to 2018. So Berkshire in total bought 5.2% of Apple and they spent 36 billion. But then they had the possibility to take the dividend, 775 million annually, but plus they have the possibility to sell already 11 billion of stocks of Apple, but at same time to keep owner of Apple by 5.4%. How this is possible? This is possible because Apple in this meantime made a huge buyback, so even if Berkshire sold some part of their stocks, actually 1/3 of them according to the evaluation, they are still owner of 5.4% of the company, so nothing is changed in ownership. This is how much important is buyback when we are investor. At same time, Berkshire did the same for their own stock. In fact, even Berkshire buy back some part of their stocks, 24.7 billion. So as an investor in Berkshire Hathaway, we have 5.2% more ownership of the company because Berkshire just made their buyback. At the end, even if Berkshire do not give us as investor a dividend, by buybacks they can give us another return because we become a bigger owner of the company. So another important point to keep in mind as value investor when we go to analyze a company, we need to understand even what kind of strategy the company apply for buybacks. If they make the buyback just when the price is high or even when the price is low, because normally the company make just like this. So it's absolutely the opposite of what Buffett says. Buffett says that the buyback should be done when the price is low, not when the price is high, as normally should be. But when we study a company, even if this company do not give us a dividend, we should analyze the buyback of the company to understand if there is some kind of return for us as investors. And finally, we can see the price action, and we can see as the price just went up since 2010, and likely the price still go up for the future because we have seen that the business of the company it's really a solid one and it's really diversified in many different sectors. So it's really likely this company will continue to grow. But more in detail, I put there some target for 2022. I put a target price of 280 and 2023 a target price of 310. So this dark blue line, it's what is my intrinsic value line. So we can say that nowadays the price of the company is actually at their intrinsic value. So we are not going to invest nowadays at a discount price. But even with we invest at fair value, let's say, we still have a possible upside return by 2020 of 10% and a possible upside return by 2023 of 22%. So every one of us, according to our own strategies, our own portfolio risk and target should understand if this kind of company, this kind of investment fits our own portfolio. In our public portfolio, you will find the link down below in the description if you want to see it. Here we are with Berkshire Hathaway. It's 4% of our total portfolio. We are already up of 24%, but it is not the most important things. In fact, according to this kind of projection of the price, we are likely to go to buy more stocks of Berkshire and follow what is the growth of the company for the further year, because this company is one of the companies that makes the core part of our portfolio, so we will keep invested in this company for a very long time. So let me know your thought and your comment just down below if you like this kind of company and if you like this kind of strategy of investing. Don't forget to click the like button to support the channel, subscribe if you not yet, and feel free to have a look to our playlist with all value investing analysis of all companies. You will find the link just above and our public portfolio below in the description. Thanks and see you in the next video.